This is Economy Watch, what you need to know about New Zealand's economic life today. Brought to you by interest.co.nz.
Kia ora and welcome to Tuesday's Economy Watch, where we follow the economic events and trends that affect New Zealand. I'm David Chaston, and this is the international edition from interest.co.nz. And today we lead with news in the growing shadow of upcoming central bank decisions. Financial markets are having a toughish time reading the tea leaves on what the US Fed will do at this week's meeting. The PCE result for June left open every interpretation, and the prior presumption of a September rate cut is in question now. Will it give the Fed members enough confidence to hold off until after the election in November, their usual non-change stance around elections, or will they feel the need to go now to prevent a monetary policy mistake? And then there are even bigger questions about what the Bank of Japan will do this week. They have now got the moderate inflation they've been seeking for decades, but seem uncomfortable with the consequences. Meanwhile, manufacturing in the US oil patch is going backwards. The last time it was positive was in April 2022. Since then, it's been steadily contracting, according to the Dallas Fed's factory survey. The July survey showed little reason to expect that trend to change. It'll be touch and go whether tomorrow's services survey improves from its narrow negative position. Another corner of the US economy that isn't doing so great is commercial real estate. According to MSCI, lenders foreclosed on more than $20 billion of loans in this sector in the second quarter of 2024, a 13% jump from the first quarter, and the most in any quarter in almost a decade. Across the Pacific, positives are much easier to find in Taiwan, where consumer sentiment rose in July to its best result in 3 years. It was sentiment driven by significantly improved family financial situations, employment prospects, and general feelings of prosperity there. In contrast, we should note that there is still no sign of China's June foreign direct investment report. This might be part of a wider pattern to keep tough news from markets to prevent them, quote, overreacting, unquote. Their equity exchanges have agreed to stop publishing daily data that gives investors the ability to calculate net flows at the end of each trading day. And their weak equity markets have many piling into Chinese government bonds, pushing prices up to record levels and yields down to record levels in a sharp risk aversion mood. Some analysts expect Beijing to intervene by borrowing and selling bonds to reverse the moves. It's a bond bubble built out of fears for China's immediate economic prospects. The US Treasury 10-year yield is now just on 4.17% and down 3 basis points from yesterday. The China 10-year bond rate is now at 2.14% and a very sharp 6 basis points lower and easily a record low. And the price of gold will start today with a small $8 move down from yesterday at $2,378 an ounce. And oil prices are down 50 US cents at just on $75.50 a barrel in the US, while international Brent price is just under $79 a barrel now. And the Kiwi dollar starts today marginally softer again at just under 58.8 US cents. Against the Aussie, we're marginally softer too at 89.8 Australian cents. Against the euro, it'll change to 54.3 euro cents. That all means our trade-weighted index starts today at 67.8 and down another 10 basis points from yesterday. And the Bitcoin price starts today at $66,928 and down 1.3% from yesterday. Volatility over the past 24 hours has been moderate, at plus or minus 2.6%. You can find links to the articles mentioned today in our show notes, and you can get more news affecting the economy in New Zealand from interest.co.nz. Kia ora, I'm David Chaston, and we'll do this again tomorrow.